In this video, we're going to talk about the income statement and try to finish up a little bit about stockholder equity at the end. But let's think about the income statement in general. Basically, it's just what? Revenues minus expenses equals net income. Now, we do make a distinction, as you can see here, between operating expenses and non-operating expenses. The reason for that, quite frankly, is just so that we can understand how well we're controlling these expenses of cost of goods sold and operating expenses. So these non-operating expenses have nothing to do with actually running the company. We can't use them to understand any efficiencies or effectiveness of operations. So we do need to separate them so that we have different things to look at and understand how the company's performing. So the operating performance of the company is measured by the success of its generating earnings, right? It's the bottom line that we talk about. So annual reports typically have 3 years of income statements. Again, they do this because we want to be able to look at and see trends, see how they're moving, how things are changing. The income statement itself typically is shown in what's referred to as a multiple step format. We break it into some intermediate terms: gross profit, operating profit, and then earnings before income taxes. Again, we do this because, number one, taxes for large companies, typically they're all the same. It's the same percentage. So looking at taxes, typically we don't get much else from that other than what the average tax that they're paying is. So again, this multiple step format allows us to review and assess the efficiency of the company. So let's look at gross profit, right? It's, again, just the difference between net sales and cost of goods sold. But if you think about assessing, right, evaluating how good the company is doing, I like this question: how well does management control the expenses of production, right? This then lays this number in the lap of management. If this number is getting bigger, then management is controlling expenses better than it had been. So it is a line item, if you will, that allows us to assess production. Operating expenses then refer to all the other expenses of running the business: selling and administrative types expenses, advertising, leases, research and development expenses. All of these are part of operating examples. So when we get to operating income, this then looks at how does the company control the expenses of running the company. So it ignores, if you look at the formula here, it's EBIT divided by sales. So what's left after EBIT? It's the other non-operating expenses, primarily interest and taxes. So again, the operations have nothing really to do with borrowing money. They're two separate decisions. They're really not connected to each other. So we don't want to include interest in understanding the efficiency of operating the company. Then finally, we have earnings before income taxes, right? So again, if you just take the income tax expense and divide it by earnings before taxes, we have what's referred to then as the effective tax rate, right? So again, all companies depending on their income, have potentially different tax rates, effective tax rates. But once you get over a certain level of income, ordinarily, everybody is going to have basically the same effective tax rate. And we're not going to talk much about taxes in these videos, but the tax code is pretty specific. Once you get over about $20 million in profits, which isn't a very big company, everybody pays the same kind of federal tax. Now, net earnings, the bottom line, is net income divided by sales. Again, this just tells us how much of sales is left over at the bottom, right? It's the profit after we look at all revenue and all expenses. And it's a number that everybody refers to, but really as an analyst gives us very little information about the efficiency of the company. That's why this multi-step income statement is so important for us. Earnings per share, I'm sure everybody has heard of earnings per share. It's the net earnings available to common stockholders divided by the average number of shares. Now, when you look for earnings per share, one of the things that you're going to find is there's earnings per share or basic earnings per share, and then there's something called fully diluted earnings per share. This complexity comes from special kinds of securities and contracts that are sometimes issued or even owned by corporations. And these are typically what are referred to as derivatives. So they are assets, securities that could be turned into stock. So the basic earnings per share is, again, it's the basic number, but fully diluted earnings says, look, if all of the stocks that could be stocks were converted, what would the number be? So the fully diluted is going to give us a much more conservative profit number than the basic profit number. So let's think about the statement of stockholder equity, right? What does that equity section look like? Sometimes this will be in the balance sheet. Sometimes it will be a statement presented in between the two. And sometimes it might even just be in a supplementary schedule or in a notes to the financial statements. So this particular statement and where it shows up is really up to where the company decides to put it. So let's think about measuring earnings, right? So we've already talked about some basic accounting principles. We talked about accrual accounting. Accrual accounting basically places adjustments at the end of an accounting period to reflect what they refer to as the matching principle. So the expenses of a particular period are noted in that period, regardless of when they're paid. An example of this is salaries or wages. So let's say that the payday is Friday and the end of the month is Wednesday. Well, you want to show statements for this month, but that month ended Wednesday. You have Monday, Tuesday, and Wednesday's pay, but you're not going to write that check until Friday. So the accrual method just takes into account those 3 days. So on the last day of the month, we would make journal entries to make those expenses in this month and that we owe them in the next month. So what do you think happens on Friday? We unwind the stuff that we owed, and then we paid it as as an expense, but only the 2 days expense for the next month. Depreciation can be straight line, it could be accelerated. So typically, companies have 2 sets of books. One is to report the financial position of the company to investors, and the other one is to compute taxes. So there are 2 sets of books. It's not really relevant in any real big detail. We just have to know that the company will be showing 2 sets of books. Again, one for investors, one for taxes. And we've already talked about research and marketing, research and development type things. Basically, we want to expense it all. Why do we expense it all? The reason it's expensed when it occurs is because we really don't have any good way to match it to products on down the line. We don't know if the products will happen ever, and we really don't know what the revenue is going to be when it does get here. So research and marketing, again, is expensed when it occurs. So here's an income statement. Again, you can see our parts. Here's gross profit, operating income, OPM or EBIT. Down here we have income before taxes. And then down below we have the provision for income taxes. So this again provides us with that multi-step model. Now, because of the accrual method and some other accounting methodologies, how do you know what taxes were actually paid? So if you look, we have something called prepaid income taxes. Quarterly, typically businesses pay taxes. So there is a prepaid tax every quarter, right, that's on the asset side because you paid them now, but they're really not due till the end. In addition, we could have increases in income taxes payable and deferred income taxes that are on the liability side. So if you take the provision for taxes, take the expense item from the income statement, add prepaid taxes, subtract out taxes payable and deferred taxes, that will tell you the actual taxes paid for the year. So here we have from Target, their income statement for 2016. They say they paid $1.296 million in taxes. On the balance sheet, the increase in taxes payable was $38 million. There was no deferred taxes or prepaid taxes, and so you just subtract them. So the actual tax paid was $1.258 million. So again, we can calculate the actual tax paid by using this little mechanism. Well, that's it for this video. I look forward to seeing you in the next one.